I'm Andre Johnson. I'm the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. Today we're going to talk about financial fitness. And I want to point out that this webinar is for informational purposes only and does not constitute legal advice. So first, a little bit about the Office of Consumer Credit Commissioner. We license and regulate certain non-depository institutions, such as all of those pawn shops and payday loan lenders you see scattering the roads and highways across Texas. And we protect and safeguard consumers against abusive and deceptive lending practices. And we educate consumers like yourself about your rights and responsibilities. If for any reason you have any concerns, complaints, questions about any of the industries that we license and register, please call that phone number right there. We have a consumer assistance department and they will help you and get you on the right path. Now, we also provide financial education through me, the Financial Education Coordinator, informational seminars and webinars like this one, financial education materials, which are in today's handouts, and you can get those at occc.texas.gov. That's also where I publish the calendar for financial webinars if you want to share that with anyone. And we partner with other education-oriented organizations. This one's really important to me. I am also the grant coordinator for our agency. And this summer, we're going to launch a new grant cycle for the Texas Financial Education Endowment. So if you guys know of any organizations, if you're involved in any organizations that might be starting any financial education programs for K through 12, adults, or financial coaching, we are going to have that information available. The application period starts this summer. And when I say K through 12, one of our current recipients is the Girl Scouts of North Texas. And then we've got organizations all across the state. So if you know of anyone that might be interested in that or benefit from that, please reach out to me and I will gladly give them the information. So financial fitness. Financial fitness can play a big role in your health. It can lead to poor physical health, delayed health care, unhealthy coping behaviors, and put a strain on relationships. Recently, I had someone share a story that she was at her doctor's office and a man came in while he was working and he needed to be seen immediately in order to go back to work. He had some kind of injury and he couldn't go back. Well, due to his copay, and she overheard all of this, it was $50 and he didn't have $50 to be seen. And since he had insurance, but he had a copay and he couldn't cover it, he couldn't be seen immediately. And he was fortunate that someone there in the waiting room stepped forward and covered, covered his copay. But see how not having that financial ability to pay his copay, he wasn't going to be seen by the doctor. And then on top of that, he was going to miss work for the rest of the day. So that played a big role in how his day was going to unfold because financially, he couldn't cover that cost. But you can deal with the financial stresses of your finances. You want to understand your cycle of debt. So if you're using your credit card every month to make ends meet, maybe create extra sources of income, work out a budget, which I have a budget worksheet today, and practice stress relieving techniques. We're not going to go over those too much. But you might have your own kind of idea of how you practice stress relieving techniques. So why does financial health matter? Well, if you have good financial health, it'll help you heal your credit, which can lead to better consumer confidence. You can set a budget and have realistic goals. It gives you a better financial outlook, and it builds for the future for things that you like retirement. So why is it important to have good credit, and why do you need it? Credit gives you the financial power to qualify to borrow money or pay for goods and services over time. And you're kind of like, well, yeah. And it means that you can be trusted to pay the money back later. But having good credit affects all of these things: getting a job, renting an apartment, financing a car, getting loans, phone service. You're going to get, the better you have, the better credit you have, the better interest rate you're going to have. You might be have more of an opportunity to get an apartment in a better location of town. You know, just things like that will play a role in your overall quality of life. So good credit versus bad credit. Good credit means you're reliable and paying bills on time, and that companies are more willing to extend credit to you, or they might offer you lower pricing. And so that's something that creditors look at, and all of those things can affect you. And so if you have bad credit to a creditor, now this might not be your situation. It might mean that you're unreliable in paying your bills on time, or you have a high debt to credit ratio, or possibly your bills are paid late, or your debts have been abandoned, or you've filed for bankruptcy, which these are all common situations. But to a creditor who's looking to extend money to you, they kind of look at this and they want to weigh their odds, right? So what's in a credit score? The longer the history, the better. So if you are just new to this and you just are establishing your credit, you might say, oh, what am I going to do? Maybe you have, you know, a college kid, or, you know, someone out there, oh, sorry about that, who's just building their credit. You know, what can they do to get on the right path? But the longer, the better. What is your debt to credit limit ratio? The lower, the better, right? So if you have maxed out credit cards and you're barely making the minimum payment, your creditor is going to look at this and say, ooh, and it's going to affect your credit score, and it's going to bring that score down. And we always want to reach for that higher score. So how many inquiries do you have? The less, the better. And remember, inquiries stay on for at least 2 years. So if you're going around and applying for every little credit card because they have special offers, you really need to weigh whether or not what you're getting that credit card for the special offer, what you're getting it for, because it's going to affect your credit score and bring it down. Do you pay your bills on time? This is another big one. So it's going to show up on your credit score, and it's going to show whether or not you are paying your bills on time, and that's going to affect how your score is. Are there any charged off accounts, judgments, or bankruptcies? Bankruptcies last 7 to 11 years depending on how you file. Someone is asking about debt consolidation, and I believe in this presentation I am going to mention debt consolidation, and we'll talk about that in a little bit. Credit scores will typically range from 350 to 850. The higher the score, the easier it is, of course, to qualify for the best credit terms. I always mention that I have a personal competition with my husband to talk about you know, our credit scores, and I always check his and check mine, and I always want mine a few extra points higher, even though it's my own, you know, personal competition with him that he doesn't have any clue about. Just makes me feel a little bit better. So there are 3 credit reporting bureaus. And keep in mind, the credit reporting bureaus do not make credit lending decisions. They only maintain and compile the information into a report, and they establish credit and check your report for any inaccuracies. And your role is to dispute any inaccuracies that you find. And I want to mention that you can go to annualcreditreport.com and get a free credit report every year and you can also get them from Experian, Equifax, and TransUnion if you want to go to the individual credit bureaus. And right now, I have a little note to remind me that right now through the end of April, the credit bureaus are doing 1 free credit report every week because of the pandemic. And so, you know, there were lots of scams and frauds going on. And so they just wanted to extend that to people to have that opportunity to stay on track of your credit and make sure that there wasn't anything going on that could affect you. So now through the end of April, you can check your credit once a week, and it doesn't affect your credit score. That is a myth. Some people think that if you check your credit score yourself, it affects your credit. If you check your credit report, it affects your credit score, and it does not. So what's in a credit report? A credit report is personal identifying information. So that's going to include any current name you have, your previous names, previous employers, current employers, and their addresses, and your addresses. And it's going to include account information, public record information, and any inquiries you have. What it's not going to include is your race, religion, medical history, political preference, and criminal record. Someone asked, if you finally reach the point where you are debt-free, do you still need to keep some credit cards active to maintain a good credit score? I almost have a yes and no on that one, because the thing is, even if you don't have, unless you have paid off a mortgage and you're not renting an apartment, or you're not purchasing a car, you still have some kind of debt. Now, if you have all of those things paid off, that's great. And, I had someone just ask this question because they have a credit card that they use routinely, not regularly, but routinely. And so they paid it off and want to know if they should just turn around and close it. But it's just a basic card that they use routinely. And I suggested, because a lot of people go back and forth on this, oh, do I close out my credit cards when they're done? And, it's been said that the answer is no. Don't just run around. If you pay off all your credit cards in a month, just don't close them all down, because that doesn't look so great on your credit report. But if you are debt-free, first of all, congratulations. And secondly, maybe I would suggest keeping one card and occasionally making a purchase. Like, I have a credit card that I keep open, and I put gasoline on it once a month just to kind of keep that, and I pay it off. And so that keeps, it keeps your history going. It keeps your activity going, because that's another thing. If all of a sudden you're just, there's no activity, then there's nothing that's, creditors might look at that like, well, what happened? Where'd this person go? So that's another thing. Just keep one open. If you're debt free, that's great. I think that's fabulous. But I would keep one open, and then that way, but just make a purchase that you can pay off every month or use it every couple months. Just show some activity, and you're still building that history. I hope that helps. So there are types of credit inquiries, hard and soft. For instance, when you have a hard inquiry, it's when a lender reviews your credit to make a credit decision. This includes mortgage, auto, or credit cards. It's considered hard because it's tied to an actual application, and it does affect your credit score. A soft inquiry is like when you check your credit report or when a lender checks for pre-approval. Soft inquiries do not impact your credit scores. So again, check your credit report. It does not affect your credit score. Your credit score doesn't go down when you check your credit report. The difference between a hard inquiry and a soft inquiry that you really want to think about is the application versus just a pre-approval. You might be getting pre-approval letters all the time. You're like, oh, is this affecting my credit? But they're just going off of like very basic information when they send you a pre-approval notice. Now, once you fill out that pre-approval notice and you fill out the application and you send it back, that affects your credit score, and that's a hard inquiry. So, managing types of credit inquiries. Of course, like I said, the fewer the better. Only apply for credit when you need it. For instance, only apply for credit when you need it. So when you're seeing those offers every time you go somewhere and they say, oh, not consolidate, but apply for this credit card, get 20% off. Apply for this credit card, get $20 off today, 5%, 10%. Just say no. When applying for a mortgage or loan, do your shopping in a short time frame. I did that, and even the mortgage person told us to do that. And regularly check your credit report. That is the biggest thing you can do to help your credit, is to regularly check your credit report. I do have a second monitor here where my questions are, just in case you're wondering why I keep looking. Someone says, if you have a high balance on a credit card, should you still be using it occasionally? If you have a high balance on a credit card, like we're talking like almost completely maxed out, no, you should not be using it regular. You should not be using it even occasionally. You need to pay it down and pay it off. When you're occasionally using credit cards, that's if it has a zero balance and you're just looking for that to keep, keep that activity going. When you are making regular credit card payments, that shows also in your credit history. So when it shows your account information on your credit report for a creditor, they see your outstanding balance, they see that you make your payments on time, and it's going to show if you have ever made, if you are behind on payments. So if that credit card is pretty high on the balance, I would pay it down, especially depending on its interest rate. And we're going to talk about debt repayment in a little bit. And there's different ways to focus on paying off those credit cards. And we're going to talk about those coming up. But yes, you want to pay it off, pay it down, and try not to use it if it has a high balance on it. So should you place a fraud alert or freeze on your credit report? A freeze generally stops all access to your credit report and is available to anyone, and it's temporary until you remove it. A fraud alert, a business must verify your identity before issuing credit, and it only lasts for 90 days. Now, to place a fraud or a freeze on your credit, you must contact at least one of the 3 major credit reporting bureaus, so Experian, TransUnion, or Equifax, by phone or online. Now, I met someone recently who actually uses a freeze on their credit report, or on their credit, because they had some credit cards being sent to their house and they had their names on them. She nor her husband had applied for them. Someone was just applying for credit cards, and there was no telling where other credit cards had went, correct? So when they checked it out, they realized, oh no, and they put a freeze on it. And they leave a freeze on their credit because it's kind of like a fail-safe and a stopgap, where when she goes, oh wait, I want to apply for this credit card, I want to apply for this loan, I want to apply for this. Well, then she has to contact the credit reporting bureau and remove the freeze. So it kind of is there and says, whoa, do you really need this? And so she just leaves it on. And if, maybe you're struggling and you maybe have an addiction to applying for credit cards, you might want to do that yourself. So how do you dispute inaccuracies? If you discover any inaccuracies in your credit report, you want to complete the request for reinvestigation from the credit reporting agency, or send a letter listing each incorrect item and explain exactly what is wrong. If an investigation does not resolve your dispute, you will be able to add a statement of 100 words or less to your file, and you need to contact the creditor. And here's what the dispute process looks like. This is what the dispute process looks like. Here's kind of like a timeline of it. So first, you notice the inaccurate information. Then you dispute the inaccurate account with the credit bureau. The credit bureau will check with the creditor to verify the information. The creditor then has 30 days to investigate and respond to the credit bureau. If the creditor doesn't respond, the information must be removed. Okay. If the creditor does respond, the item will either be deleted or verified. And then a new copy of your credit report is sent to you. And then you're entitled to the statement that I just mentioned to dispute any negative marks or complaints you might have. So what I always think about here is that 30 days right there. I always think about when I go to the grocery store and I swipe my debit card, the money comes out immediately. But if I need to return something, it is not immediate. So although you go to the credit bureau and you check your credit report and you notice some mistakes, there is a timeline for these things to happen. It is not overnight. And so you just got to be patient. You can get it taken care of, and you want to take care of one thing at a time. So in order to work on your inaccuracies, you want to reestablish your credit. And the ways you do this is stability. So employment, payments, staying in the same home for an extended period of time. Remember, again, it takes patience. This is not an overnight process. 30 days. They have 30 days to respond to you. And that's 30 days after you've contacted the credit bureau. So you contact the credit bureau, you finally do the paperwork. Let's say it takes you a little while to get it filled out. Then they contact the creditor. The creditor has 30 days to respond, a whole month to respond. Then the decision comes back. Then you get to know what it is. Then you get to file your if you need to write up the statement. Okay, so see, it's a process. And it's slow and steady, and you want to tackle one thing at a time. So if you see multiple things in your credit report, don't try to just go after it all at the same time. Just slow and steady, kind of like that little turtle there, and focus on one thing at a time. You can reestablish your credit by applying for a secured account. This is good for people who don't have a lot of credit history. So this is a loan or credit card secured by a small savings account. So what would happen is the savings account would have the money that's attached to the card. And so that's why that card is secured, and you could go through and use the card, and that'll help you establish your credit. Now, a lot of people think about debt settlements. There's lots of stuff out there right now that talks about debt settlements, and you want to consider your pros and cons. One pro is that debt settlement may help you pay off your debt for much less than you owe. And on the other side of it, it could impact your credit, and it will be there for quite a while. And somebody asked about consolidating cards earlier, and I also think about debt settlement because we're talking about consolidating a whole bunch of stuff. So when you're thinking about consolidating a credit card, you'll see a lot of places that say 0% interest for 12 months. If you are going to be able to pay off whatever debt you've consolidated during that lower interest period, fine. I think that's great. But, and whatever that lower interest period is, maybe someone has 2.5%. I don't know. I see a lot of things advertised for 0. You look at the fine print and you see what the interest rate is going to be after that special period. If you are still if you look at your budget and you're still going to have debt when that time is over, that time period, then consolidating probably isn't going to really benefit you unless you have really high interest rates on everything you have, right? So consolidating at that point probably isn't going to be the best idea if you're not going to have that debt paid off in whatever the time frame is that is the lower interest rate or the better time period. Let's see, someone asked a question. If you receive credit applications or other mail addressed to someone with your last name, but the first name is different, does that mean someone may be using your personal information to try to get credit? Well, I mean, it is a possibility. That is definitely a possibility if you're getting credit cards like that, especially credit. I mean, it could just be a mix up on one thing, but make sure in order to combat that in any way, I would probably call the company that sent you the application. First of all, that's one of the things I would do. Definitely check your credit report, see if there's any fraudulent accounts on there, because just because you haven't seen the activity, or just because you haven't gone to a store and been denied, or your bank account hasn't been wiped out, one of the things you are looking at your credit report for, not only are you looking for open fraudulent accounts, you're making sure that every name on your credit report is a name that you have had, every address, every employer. You know, one of the ways when I think I went to Experian recently, because I just wanted to go to, you know, pull up my credit report. And I went to Experian, and they go through that thing. Out of these 4 cars, which one have you owned? You know, the little questions, so they make sure that you're the right person. You know, out of these addresses, where have you lived? You check the one that you've actually lived at. So that's another reason why you're checking your credit report, is because you're not just checking to make sure you don't have $50,000 in debt for credit cards you've never heard of or a home you've never purchased. You're checking it to make sure your names are correct, your employers are correct, your addresses are correct, the accounts that you do have are accurate on there and correct. So if you are getting, like they said, credit applications addressed to someone else with your last name, but the first name is different, check your credit report. It's free. Right now through April, it is free every single week to check your credit report. And that is one of the best things you can do to help monitor those issues. I definitely sound like an advocate there for checking your credit report. So another thing we want to talk about today is budgeting. There's budgeting percentages, there's the 50-20-30 budget, the 80-20 budget, and zero-based budgeting. I definitely fall close to the zero-based budgeting because I need to know where every dollar is going. So the 50-30-20, you have 50% for your needs, 30% for your wants, and 20% for savings and debt repayment. The 80-20 is 20% goes to savings and debt, and then 80% goes to everything else. Zero-based budgeting, you're going to balance your income and your expenses, and every dollar has a purpose. It's kind of like the envelope method, where people actually take envelopes, put money in each envelope, and it's labeled, and that's what you're going to use in those different areas. And whatever you have left over is the money in your pocket, you know, for miscellaneous things that might come up, like a pack of gum at the gas station. So creating a budget. First of all, keep in mind that everyone is different, but these are some basic guidelines, some percentages that you might want to stick to. So 25 to 30% for housing. That is everyone's usually that's everyone's biggest money crunch item, right? Transportation, utilities, insurance, and food. You'll notice that they're all pretty important, and they're on the left side of the screen. So the left side of the screen is really important. The right side is where there's going to be some give and take. Entertainment, miscellaneous, personal spending, savings, and giving. This side is where, if you're finding yourself tight on the left side of the board, this is where you're going to cut back on the right side. And these percentages, of course, are based on your total after income tax, but before 401k, medical insurance, and other contributions you might be making, or your employer. So this is what a example of zero-based budgeting will look like. So you'll see you've got your income at the top, and then everything kind of falls into place. You'll notice, though, that entertainment, personal spending, and miscellaneous are not 5 to 10%, because there is a student loan on this worksheet, on this example. So if you have a student loan, that falls into the left side. That's something that has to be paid off, and it's really important. So you want to make sure that you're taking from the extras, you know, the personal spending, the entertainment, and miscellaneous, to make sure that you're covering the cost of something like your student loan. And this is more of a breakdown of what the budget categories are. So housing, this is your rent, your mortgage. It includes things like your property taxes and your homeowners or renters insurance. Then transportation, your car maintenance, gasoline, public transportation expenses, and parking. Utilities, electric, water, gas, trash, and of course, our cell phone. And insurance, health insurance, life insurance, car insurance. So make sure these things are all in your budget. Other categories include your food, and this is not just the groceries that you're buying, but it also includes eating out. And I will tell you that in my house, it is a real struggle to keep the food budget in order because I will go out, buy the groceries, come back home. You know what? It's exhausting walking through the grocery store sometimes. And I will come home and just want to buy lunch or just go out to eat. I don't want to do dishes. I don't want to cook. So it's really hard to keep this one on track for us at our house. Then you've got entertainment, and this includes things like Netflix, maybe your Disney Plus, your Hulu, your Prime, your Peacock. I mean, there's so many different streaming services right now that could be included in entertainment. And maybe for some of you, those services are not entertainment. Maybe that goes back to, you know, utilities in an essence almost. But those are things you could live without. You know, we have an antenna. We don't even have cable at my house. Miscellaneous things include extra funds for things that might come up during the month, because they always do. Personal spending such as haircuts, and my 2-year-old's getting his first one tomorrow. We're very excited. Well, I'm very excited about that. And always remember to pay yourself first when it comes to your savings. And that might sound interesting in the sense that pay yourself first. How much will I know? Well, that's why you're going to create a budget. You're going to see how much is going to all of these little categories. And you're going to make sure that you are putting money away for yourself. You got to have something there. $5 a paycheck even. Just put something aside for yourself. I know that when I take out cash, like if I take $20 out when I get paid and I put it in my wallet, it takes forever for me to spend that cash. So what you also could do, and what we also do, is we have a working account and a non-working account. And the working account, of course, is like our paychecks, and that's where the mortgage comes out and the bills and all that stuff. And then we have what I call the non-working account, which is a savings account. And so we have a direct deposit that just automatically goes there, and you're automatically saving something, correct? Also think about if you have any charitable causes that you give to. Someone recently was surprised to find out that they could write off their tithes and givings for their church. And that goes into giving your tithes and offerings that you might have for church. How do you know how much to put in each category? You want to review, in addition to the percentages that we talked about, the 25 to 30% for housing, transportation, 15 to 20%, so that you want to review your receipts, your credit card or your bank statements to see what you are spending, really spending in these categories on a regular basis. So maybe you want to go back and look at, January. Well, I say January is probably a good one. December, it's Christmas time. So people, you might have been, there's lots of holidays and Christmas. And so you might have been buying more presents. And then Thanksgiving. So maybe, look at January and November to get an idea. Or maybe just look at this past month, February. Or look ahead to March and really keep track of what you're spending in March. Save those receipts. Keep a ledger. Write stuff down if you need to. Because, bank statements can get real, look at your bank statement. But I know when I look at my bank statement, I go, well, what was Manor Express on the, I don't know what that was. Was it gas? So, just keep track as you go along. That might help. So track first and then budget. If your after-tax pay isn't enough to cover all of your expenses, you want to adjust those categories. And I have a budgeting worksheet in the handouts today that you can use. When your income increases, don't increase your spending, stick to the same budget. I always say when your income increases, you know, if you're fortunate to have your debt paid off, set up a savings account, a separate account that automatically, if you're getting an extra $20 a month, that $20 a month is going into that account and you don't even see it. So things don't change. Never had it, not going to miss it. Pay off debt and save the extra money. Prevent late payments, because if you think about it, one late payment this month, one late payment next month, you are just giving your money away at that point. Save for emergencies or pay more than the minimum on credit cards and loans. And we're about to talk about that next. And remember, expenses you pay less frequently, like annual tax payments or car registration. So if there's things that's going to come up, and they always do, you know, I need new tires on my car. So that's what you're saving for. And, you know, think about that when you're building your budget in those categories, that those things are going to come up. Debt repayment. So here's where we're going to talk about how to pay these things off. When you're looking at your budget and you go, oh, I got a lot of credit cards. Think about the debt snowball. I like this name. You're going to pay the minimum payment on everything, and any extra goes to the smallest balance. So regardless of the interest rate, let's say you have a credit card that has only $200 on it, but it has a horrible interest rate. And so, but the balance is so low, so maybe your interest payments every month aren't that high, or your interest charges aren't that high every month, so you don't really think anything of it. Well, you're going to focus on that small balance. Get it taken care of, get it paid off, get it out the door. You don't need it on there. And then make the minimum payment on everything else. Okay. That to me is the one that's more like instant gratification. And you know, everyone is so on demand nowadays, you know, when it comes to streaming services and DVRs, because you don't want to watch through commercials. So that kind of gives you that instant, it's paid off and we're ready to go. And you can focus on the next one. The debt avalanche is where you're going to pay the minimum payment on everything, and anything extra goes to the highest interest rate. So regardless of the balance, you're going to focus on that card with that really high interest rate, or that loan, whatever it is. And you're going to put more onto that one, because what's hurting you there is those interest rate charges. So, you know, the higher the interest rate, the higher the charge on your balance. So it's going to just keep pushing that balance up. So you're going to get that paid down. And you'll start to see, it may take a little bit longer because you're focusing on something with a higher balance, or a higher interest rate, sorry. Consolidating credit cards. This is where, so consider balance transfers, but watch for the fees. And I mentioned this earlier too, and someone had a question about it. Again, when you go to consolidate a credit card, balance transfers may not work because there could be fees for the transfer. And then what is going to be your interest rate at the end of whatever, why ever you're consolidating? You know, like I think about this a lot when people are making those offers for like 0% interest for 12 months when you transfer this, or, you know, this lower interest rate, and maybe that's why you're transferring. But always think about the fees involved when you're consolidating credit cards, and whether or not you're going to be able to actually have that debt paid off during that, after that special time is over. If you haven't already, you want to stop using credit cards or other debt to finance your living expenses. To me, this is kind of like cyclical debt, in the sense that you get to right before your paycheck, right before your pay period, and you have to whip out the credit card because it's just not getting there. What are you using it for? What got you there to where you're not getting to the end? I can tell you at my house, I have 3 birthdays in the next week and a half and a wedding anniversary. And so it happens, you know, you're going to get there and you go, ooh, because buying birthday presents, thinking about buying cake, because I really don't want to make one this year. And so the credit card then becomes this, oh, okay, well, just this one time, you know, but that one time becomes next time and next time and next time. Allocate extra money into debt repayment. So if you've got extra money coming in, like maybe you've sold something, maybe you have a side job, something. Maybe you're driving for one of those rideshare companies. Maybe that's a way to get some extra money and pay off the debt. Ask for lower interest rates. Someone, you know, I mention this every time, and I feel like if we were in a group, you guys would laugh collectively. But the last time I did a webinar and I said, ask for lower interest rates, someone replied in the chat box and she said that's how she got her student loans down, her credit cards down, her car payment. I think her phone bill, she said she got her phone down. I think that's what she said, but she just called and asked. She just talked to people and they lowered her interest rates on different things. So it happens. You just got to ask. The only thing they can say is no, right? Do you have any suggestions for increasing income by any chance? If you do, you can put those in the box. Someone says, will they still lower interest rates even if your balance is high? It really depends. All you can really do is call and ask. If your balance is really high, you know, we talked about consolidating credit cards, you know, maybe look at the fees and things involved with consolidating or transferring to a different company, possibly. And so, but that's the thing, you can just call and ask. I can't really tell you what they would say, yes or no. Personally, a few years ago, I had this happen and I called and asked, and it wasn't an option for me at the time. Now, I don't know what they would say. You know, as far as my credit goes, I'm in a much better place. So, any suggestions for increasing income? Check your paycheck deductions. Do you have any options, any deductions that you can eliminate? And are your tax withholdings appropriate? Are you withholding too much from your paycheck? Are all members of your household who can work, are they working? Are they chipping in to make it easier for you? You know, or do you have a talent where you could increase income on the side? For instance, I work with someone who is, I know someone who is in IT, and she has launched an earring company, and she's doing really well, and she's making lots of earrings on the side, and she has an Etsy store. So if you have a talent like that, you know, set up an Etsy store, set up a online store. You know, I've had success selling stuff through Facebook Marketplace, because working from home, you know, I look around, I go, what is all this stuff, you know? And as the children get older, I'm getting rid of baby toys that way and baby items, you know, selling things like that. So that's extra income that you can just put, you know, I usually, when I get extra income, I put it in my savings account. Someone said they bake cakes and pies on the side. There you go. That's a good one. That, you know, that's something you could do, is you can, you know, that's a skill, that's a talent. You know, I got 3 birthdays coming up that I don't want to bake for. There you go. Do you qualify for any government benefits? This is something you should also look into. You know, see if there's any benefits out there that you're missing because you just haven't looked into it. Can you get a part-time job? There are so many different things out there right now. You know, so many different companies to drive for, you know, DoorDash, Lyft, Uber, Flavor. There's all those food ones that I can't think of. There's tons of food ones out there because, you know, we want our food, but we don't want to have to drive to go get it, especially during rush hour. Consider selling what you don't need. Like I mentioned earlier, I'm sitting around, working from home and I see items that we don't need or want anymore and we're not using. So those become an extra source of income. And what I do is I take and put that money into our savings account. Anytime I sell something that I'm not expecting to sell, that I put that money away somewhere else. So, what does building wealth mean to you? And before we start this, I'm going to ask y'all a polling question to see if you are awake with me. Do you have any goals for building wealth? Yes, no, maybe you haven't even really thought about it. Maybe you're not sure what that means. Maybe you think that building wealth just means having a fancy house and being rich, but it could include having money in the bank for unexpected expenses. It means saving for your retirement, making an addition to your home. Maybe that's what building wealth means to you. Let's see. 68% of us say yes, we do have goals for building wealth. 5% say no, and 26% say they haven't really thought about it. And I'm really not surprised that some of you haven't thought about it, because you might not, when you hear building wealth and you think of the word wealthy, that could conjure up certain ideas, like a fancy car or the big house. But like I said, it also has to do with retirement. It has to do with maybe having money set aside for unexpected expenses, or maybe it is buying a new house, or just having some cash in your pocket. But when it comes to building wealth, the first thing you need to do is determine your net worth. So your net worth is going to be your assets, anything an individual or business has of commercial or exchange value, then your liabilities, money you have, and it's the same as money that you owe, sorry, not money that you have, but money that you owe, so your debt, and then your net worth is the difference. And like I said, I'm working on a fillable PDF for this, so you can kind of gauge where you stand, because you know what? Probably everyone has a little bit of net worth. And this is what it looks like. A real quick balance sheet, you'll see. So you've got your cash in your pocket, your savings accounts, any stocks or bonds you might have. Your retirement is part of your net worth. So find out what that is. The market value of your home is part of your net worth. And then any assets, like for instance, one of our vehicles is paid off. One of them isn't, but one of them is, right? So that goes into my assets. And then your liabilities, your mortgage, any home equity loans, a car loan balance, credit card balances, student loans, and miscellaneous liabilities. But you'll see at the bottom of the sheet, you do have a little bit of net worth, and that might make you feel better about yourself, and it might help you think more about financial goals instead of just financial stress. So what are some financial goals? Well, there are short-term, intermediate, and long-term financial goals. Short-term goals are going to take less than a year. So an emergency savings account, small household repairs, maybe a weekend getaway. I think about, the fact that I need to fix one of my bathroom sinks. That's a very small household repair, but I need to do it. And you need to budget not only the money, but the time it takes to do it. Intermediate goals, those take 1 to 4 years. So that's going to include maybe a down payment on a vehicle, extended vacation, a major home repair, like the deck that I would like on the back of my porch in my backyard, and a long-term goal, so 4 years or longer. So maybe a down payment on a house, maybe buying a new boat. Doesn't that sound lovely? And retirement. Retirement should always be back there somewhere, because at some point you might need to retire, even though you don't necessarily want to retire. How do you achieve your financial goals? First of all, you write them down. You make them visible, and you want to be specific and make them achievable. You want to write them down, physically write them down, and put them somewhere where you can see them. You know, I look this way because my door is that way, and that's where I keep our financial goals posted so we can all see it. How much will it cost you? And we're not just talking about the money. We're talking about your support system and the sacrifices that might be necessary to make this happen. You know, I mentioned building a deck. Well, I'm not building a deck, but financially, I need to figure it out so that probably my husband, my support system, is the one who's going to be building the deck. And so that's his time and, you know, things that he's going to have to do to be involved in this. You want to communicate. So rank your goals and share them with your family or your friends, actually, because, you know, maybe you're living alone and you don't have a big family. Make sure your friends know that you've got these financial goals. You know, they're going to be there and they're going to know that when you go out to, you know, I had a shoe addiction years ago, and so people knew that I couldn't go to shoe stores, and my friends were really good about keeping me away from shoe stores. But they're going to know that, you know, maybe you can't go to the fancy dinner or the fancy brunch because you're trying to save money for something that's important to you and way more important. You know, maybe they'll suggest coming to your house for brunch, you know, and you guys make pancakes together or whatever it is. Establish a timeline. So if your goal is to save $1,000 for a new car, this is just an example, and you have 18 months that you want to do it in, you want to set aside roughly $56 a month in those 18 months to achieve that financial goal. And that would be easy to do. At my house, that is a family of 4. That is not eating out 1.5 times a month. I mean, if we skipped eating out once a week and I put that money in a savings account, be there in no time. Also, when it comes to achieving your financial goals, be flexible and keep your eye on the prize. You may have to reset or compromise, but that doesn't mean you are unsuccessful. For us in our household last year, it was a rough time for aging pets. And that really cut into our savings, but that was important. You know, it wasn't something that we could foresee, but it was important that we had the money to take care of that and to take care of them. So remember, as you're working towards your goals, like paying off credit cards maybe and getting out of debt, don't be too hard on yourself. You're going to have a setback, like I just mentioned. There's going to be things in your way. There's going to be obstacles. There's going to be birthdays. There's going to be holidays. And you're going to have some setbacks, but keep going forward. Keep putting that money away in your account. $5, $10, $20 a paycheck. Just keep doing it, and you will see a difference. Again, I am Andrea Johnson. I am the Financial Education Coordinator for the Office of Consumer Credit Commissioner. Today we talked about financial fitness, and I hope we're all feeling a little bit more fit today. You can follow us at Texas Financial Education Endowment on Facebook and on Twitter at Financial Ed Texas. Again, those have to do with the grant that I am so very proud of. If you have any questions today about today's webinar, please email me. You can email me right there at financial-education@occc.texas.gov.